Welcome back, everyone. So, last time I talked about Robinhood. Robinhood's great. I fully support them. I hope they do fabulous, and I will be using them in the future for certain things. But for now, I do have my portfolio here of 35 stocks, obviously, and I've actually got deposit pending. So this will be over $3,500 I've deposited, and like $67 profit um, if I was to sell everything. Um, Not counting dividends I've taken. But I've only been doing this for a month, so I really have only received, I'm only getting like 6 dividends, so, and they're all pennies. Anyway, long story short, Robinhood's great. The only downfall is that you have to buy one share at a time. You're buying and selling completely on your own. You have total control when to buy and sell. It's all real time. Um, the other downfall is you'll have money left over sitting in your account doing nothing because you can only purchase full shares and you don't have enough money to purchase another share of a stock that you want. So for dividend investing, this works just fine as long as you want full control and you want to be able to sell immediately at a good price and you're watching those prices, you know, religiously. But I found another tool that's better for dividend investors, much better. There's pluses and minuses to that one as well, but today I've decided to open an account with them. I will probably be transferring most of my balance here, if not all, from Robinhood over to M1 Finance. Now, M1 Finance looks a little more complicated. It's not complicated. It's pretty easy. Basically, you create a pie, um, and they have some default pies in here if you really want to. So you want to make income for that type of stuff. Come in here and say I want to do all domestic dividends. So I click that. Performance. Basically, these are what they're investing in this pie. Each one of these is considered a slice of the pie. It could be an ETF, which is what or fund like these are, or it could be individual stocks. If you go to my portfolio, mine looks rather complicated. It's got a bunch of slices. It's actually got 68 slices, if I remember correctly. Yes, 68 slices in this pie. All right. Each one of these, you'll see my expense ratio is 0 because I am not investing in ETFs or mutual funds or any of that good stuff. I don't even think they have mutual funds on here, but ETFs. I'm not investing in any funds or anything that charge a fee. Therefore, I'm only investing in individual stocks. All 68 of these are 68 different companies I'm investing in, as you can see here. Um, so basically, what you do is you come in here, you set up your pie. You create your own pie, and you can add. So if you go to edit here, add, you can add whatever stocks you want into your pie. Okay. Um, and then you set the percentage that you want to put into there. So out of this portfolio, I want Southern to be my biggest holding. So out of all the money I invest, 5% of that money is going to go into Southern. And then 4% is going to go to AT&T, 4% of my money is going to Duke, 4% is going to General Mills, et cetera, et cetera, et cetera, all the way down through all these 1% I've got. So if I invest $100, $5 to go there, $4, $4, $4, et cetera, $3, $2, $1 in each of these. So that's how it works. Now, the great thing that I like about M1 here, and I haven't started using it yet because I'm waiting for my bank account to be verified. I have to wait for those 3 little deposits to show up in my bank so I can verify my bank account. Anyways, long story short, and as you can see, this is a Roth I set up. You can also do normal taxable ones. Heads up, if you set up an account, just a normal taxable account, I believe the minimum deposit when you first set up your account is only $100. If you set up a Roth or an IRA, the minimum deposit is 500. Just so you know. Anyways, what was I saying here? Long story short, you set up your pie. You set up your percentages that you want to go in each one of those, and that's it. Then you deposit your money, and this will automatically deposit the right percentage in your pie. Now, the great thing I like about this is I was worried because I'm like, okay, well, I have these percentages set. I want 5% there and only 1% here. Will it automatically sell if this gets too big? Say that stock goes up by $10. Now my overall holdings in this is more than 5%. It's actually 7%. Will it sell 2% of those and move them over here? No, it won't do that unless you hit this rebalance button here, and you ask them to purposely rebalance it. That's the only time that will ever happen. The way they keep these percentages this way is from your deposits. So any new money coming in, say this one went up and it's actually 7% of your whole portfolio now when you've only got it set to be 5. When you put new money in, it won't buy this stock. Instead, it'll buy a stock that's not up there. So like this one, say, is supposed to be 3%. Well, if it's only at 1%, it's going to buy that stock and not buy that stock. That way it balances it out to be more of what you want until you get to your target of 5%, 4%, etc. And as you can see here, actual and target, you'll see the actual percentage of your entire portfolio right here, and you'll have whatever you have your target set at. I love this. They're never going to sell stocks on me without me requesting it. So I don't have to worry about that rebalance. It automatically rebalances when I deposit more money, so I get exactly what I want. The other thing is, where is it? Right here. So cash balance control. By default, it'll auto invest all of your money. So any money that comes in here, it'll automatically buy stocks in the percentages that you want. So anytime the balance exceeds $10, that's when it kicks into a market buy, and will invest your money. You can also set it to auto invest over a certain amount, so that way you can keep, say that you want $1,000 in here that you don't want invested, then you put $1,000 here, and it won't invest any money until you get more money over $1,000 into your account. Or you can just have it non-invest automatically at all, and then you have to go pick it and tell it what to invest in. So yeah. Anyways, long story short, I like this. It'll automatically invest anytime there's over $10. Now, the only problem with that is with dividend investing, when you first start out, you're not getting $10 in dividends. Excuse me? Yes, I'm a smoker. So, anyways, so when you're first starting out, you're not getting $10 in dividends every week, every month, whatever, unless you deposit a large chunk, of course. So I found the solution to this is in your deposits. When you set up your deposits, set them up to deposit $10 at least once a week. That way, all of the dividends that you receive throughout a week, once you deposit $10, it guarantees that it will invest your $10 that you deposit plus all those dividends every single week. So that's one way to get around that. Otherwise, you can just let it build up to $10 and it'll automatically deposit, which makes for a nice what they call a DRIP, which is a dividend reinvestment plan. Now, these aren't officially DRIPs. An official DRIP will reinvest back into the exact same stock that, so say Southern paid out 10 cents. Well, it'll automatically buy 10 cents of Southern. But what this does is it waits until you have $10 in here, and then it'll purchase all the stocks. It'll divide that $10 amongst your entire percentage and try to keep that balance that you have set, 5, 4, 3, etc. percentage. Hope that makes sense. It sounded like I confused it. Anyway, long story short, if you didn't do anything, if you never logged in here, if you didn't do anything and you had dividends coming in, those dividends will eventually build up to $10 and they will automatically reinvest that $10 for you. So it's kind of a buy and hold and forget. Like if you wanted to invest, say $1,000 right now into your pie, into all these stocks, you throw $1,000 in and you never look at it again for 10 years, it'll automatically take any dividends that you make and reinvest them over and over and over and keep buying more and more of these stocks with those dividends. That is amazing. You get compound interest build up and you don't even have to worry about it. It's awesome. So for dividends, this is the better tool. The other reason it's better is partial shares. So I can buy, say, like there's stocks out there. Now, this isn't a dividend stock, but Amazon. Amazon stock's like, what, over $1,200 right now or something? Let's see. Oops. Oh, I'm sorry, almost 2,000. Almost $2,000 to buy one share of Amazon. Whereas with M1, I want to invest $50 in Amazon. Boom, I got $50 of Amazon because I can buy 0.00032 whatever per, uh, of one stock. So it will automatically divide it up. I'll put $50 in Amazon. I'll own like 0.003 whatever shares of that, and then Verizon, I'll own 0.002 whatever shares, et cetera, et cetera. So you can buy stocks that you normally couldn't buy with this as well. And when you receive dividends from those companies, it will pay out those dividends based on the percentage of shares that you own, including those up to a penny. Um, of shares. So if I only own 0.034 whatever percent of one share, I will get that percentage of whatever the dividend payout is. So it's great. I mean, partial shares is amazing. It allows you to do this and split it up among all of them, even without buying full shares. And of course, as you keep reinvesting, of course, you'll have full shares. You'll have more than one full share. You'll have 2.35, whatever. And it's just partial shares allow all of your money to be working for you at all times. And that's amazing. So for dividend investing, M1 is made for it. Um, Long term, buy, hold, get dividends. M1 is just perfect for it. It'll automatically reinvest the dividends as it builds up to $10. It buy partial shares, so you're always invested, always have the money invested, making money for you. Um, Now for the downfalls or negatives to M1. Um, the biggest negative is you can't buy and sell real time. So they have one trading window every day that the market's open. So Monday through Friday, when that market opens, well, actually, I believe their time frame is 9 a.m. Central. Yeah. So 9 a.m. Central time, that's when they start doing all their trades for their entire company. So everybody's orders will start processing at 9 a.m. every day, and it'll go until all the orders are done. So, and that's it. It doesn't matter what the price is at the time, nothing. That's it. So if you want to buy low, sell high, all that, then you need to use something like Robinhood. It's just a much better app. It's real time. You can buy low, sell high, do your trading, that type of stuff. No commissions. It's great. Oh, by the way, M1, no commissions, totally free, same as Robinhood, but it's got all these extra features. So I highly recommend it for dividend investors. So just to recap, positives: you can buy partial shares. Your money's always working for you. It automatically reinvests dividends. It'll automatically keep your portfolio balanced. Um, and you can set up your pies however you like and buy exactly what you want. Um, Cons are you can't time the market. You can't buy at a low price, sell at a high price. I mean, you might, but they only do trading once per day for the entire everybody. Um, so you're more concentrated on how much you're investing and not as much on what the stock price is at the time that you're buying it. Which is fine over because you're doing dollar cost averaging over a long time. If you're constantly putting money in or reinvesting the dividends over time, you're constantly buying shares over time, you're going to get the average price for that stock. It may be higher at times when you're buying it, it may be lower at times when you're buying it, and so your average will be in the middle. So that's called dollar cost averaging. So you don't really need to care about what the current stock price is. As long the thing to concentrate on, in my opinion, is to concentrate on buying solid companies that are willing to buy and pretty much hold forever. These are companies that have a track record of solid financials. They're not going anywhere. Excuse me. Um, and you're confident that they're going to continue paying out dividends or even growing those dividends, which is what all of mine do. I think except one has a track record. Every one of them has track record of over like 10 years of constantly growing dividends every year. Um, so yeah, I think M1 is perfect for dividend investors, because dividend investors, they buy for the long term. They buy that stock and plan to keep it forever because they're trying to get that dividend income. It doesn't matter what the stock does, whether it goes up, down, it doesn't matter. As long as that company is in business and still paying out that dividend, you are a happy camper, and your investment is good. Um, the other thing about dividend investing is you have to see the market a little differently than most people in the news does. So, well, most people will freak out when we have a crash, stock market crash, and prices start dropping, and oh my God, I paid $150 for this, and now it's only worth 28. I lost all this money. No, you didn't. The only time that you lose that money is when you sell that stock. Now you've realized that loss. For dividend investors, we don't plan on selling. We're going to buy this thing and we're going to keep it forever, unless something happens to the company. I mean, if the company finances start looking really bad, or they start dropping their dividend price, how much they're paying out, or they cut the dividend altogether, that's when we're going to consider selling. Other than that, we're planning on keeping these companies forever, so we can get that dividend forever. So we don't really care what that price does, whether it goes up, down, whatever. As a matter of fact, we prefer if it drops, because if it drops, it goes on sale. So for dollar cost averaging, that lowers our average price that we're paying for that stock, for all the shares of stock that we own. So say Southern's trading at, I don't know, let's just go look at Southern. So Southern's trading at 43.91 today, or was previously yesterday, whatever. Anyway, 43.91 is current stock price of Southern. So say I buy 5 stocks today at 43.91. Tomorrow it jumps to 48. I buy 5 more stocks. Next day it drops to 42. I buy 5 more stocks. Next day it drops to 23. I buy 5 more stocks. I'm basically buying it on sell at 23 because it's low. So it's kind of like, say, a retail store when they have big sell and drop all their prices. Everybody rushes to the store to buy. But in the stock market, when that happens, everybody runs, everybody sells and loses money because they're scared. They're scared this company's going to go out of business. I'm losing all this money. They just see the amount of money they're losing because it's going from 43.91 down to 23. Now I've lost half my money I put into it, but you haven't lost it yet. You only lose it if you sell it. You have to have the confidence to hold through that downturn. And history's shown most of the time when you hold a stock through the downturns, you're going to end up profiting in the long run. And that's just on capital gains. So we aren't worried about capital gains as a dividend investor. We're worried about that dividend. The only time we're going to worry about capital gains is when we have to sell for some reason. If a company stops paying dividends, that type of stuff, then we're going to look at our capital gains and say, oh, I might have lost or I might have gained here. Do I want to sell? Do I want to try to see if the price goes up? That type of stuff. But that's the only time we're going to care. We plan on buying and keeping forever. M1, perfect for that. Absolutely perfect. I highly recommend this. This is my go-to tool at this point, even though I haven't even started using it yet. But as you can see, I started my account. I'm getting it set up, and I'm immediately going to start investing in this. Right now, I'm going to do all my Roth, which is, by the way, Roths are amazing. If you don't have a Roth, you should get a Roth. All the growth, all the capital, everything that happens in that portfolio, no taxes. It's great, but there's a limit on how much you can deposit every year. I believe it's like $5,500 a year. Anyway, highly recommend it. Get your Roths going and go from there. I'll probably also set up my taxable account over here. I'm not sure. Actually, what I think I'm probably going to do at this point is I'm probably going to take the money I have out of Robinhood, which I probably won't do for a couple of weeks because I'm still waiting for deposits to go through. But I think what I'm going to do is probably sell off any of these that I've got a profit on. So if I come in here and I go my total return, any of them that I have an actual profit on, all these pluses here, I'll probably sell off. And even some that I don't really care about. Oh, I lost 3 cents. Who cares? I'll probably sell off almost all of my stocks out of Robinhood, since I am moving into a dividend investing portfolio and not a overall trading portfolio. And I'll probably take all of that money and I'll probably just throw in my Roth. I probably won't even set up a taxable account on this yet. I don't need the money right now. I've still got a job, still got an income. Um, so I'll probably move that money into my Roth since it's tax-free growth. The other great thing about Roth is you can always pull out your contributions. So whatever amount I've put into my Roth, I can always pull back out with no taxes, no fees, nothing, even if I'm not 59 and a half years old. Any growth, any profit that you make on your portfolio, of course, you cannot pull out unless you're 59 and a half, or there will be big fees and stuff because it is a retirement account. But Roths are amazing because you can pull out what you've contributed and there's no taxes. So Roths are just amazing. Get a Roth. That's all there is to it. Get a freaking Roth. So anyway, until I max out my Roth, I probably won't even set up a taxable account on M1. Once I'm maxing out my Roth, then I'll probably set up my taxable account and see if we can't make some more money that way. Right now, these 46, what was it? 68 holdings I have in here, 68 companies. They're all pretty solid companies. They all have a history of increasing their dividends and whatnot. The only exception is this one right here, which is Safe. This one is more of an opportunity stock for me. It's a much riskier stock because it's only that company's only been in existence for a year, a little over a year. They are a subsidiary or something. They're a little break off of another company that has been around longer. Anyway, I have high hopes for that one. They invest in ground leases on real estate. It is a REIT, real estate investment trust. So that's kind of my one risky stock that I'm trying out. The rest of these have all had like 10 plus years of dividend growth. So not only have they paid dividends for that long, they've also grown that dividend every single year for that period of time. So they're pretty safe. And I've looked at the finances. I've looked at the 10Qs or is it 10Q? Yeah, 10Q and 10K. The finance statements, the quarterly and annual finance statements, and compared them to previous years and see that they're still growing and still doing good. They don't have too much debt, that type of stuff. I've done that on maybe 30% of these. The rest of them I'm just taking at face value because there's something out there. Because if you do a search on Google for something called Dividend Aristocrats or Dividend Champions, you will find a list of stocks. So Dividend Aristocrats is a list of stocks who have not only paid a dividend for 25 years straight, they also have increased that dividend every year for 25 years straight. Now, that shows that the company's pretty solid, especially considering that they survived and went through the 2008-2009 stock market crash when the real estate bubble popped. And they not only still paid a dividend throughout all of that, they also kept increasing it. So that's a sign that the company is pretty stable. And for a future crash, they hopefully will continue to do the same thing. So Dividend Aristocrats, that's a great way to get started with investing if you don't want to get into all the details of financial statements and cash flow statements and balance sheets. If you don't want to go look at all that and you just want to kind of not necessarily take someone's word at it, but just want a safe investment that you don't have to do a lot of research on. And if you don't want to do your due diligence, I'm not saying to do it this way without doing your due diligence, because when you invest, you should know what companies you're investing in. But it's a pretty safe bet to invest in most of the Dividend Aristocrats. They're not going anywhere. They've paid dividends for over 25 years. They've grown those dividends every year for 25 years. They're solid companies. So that's one place to start. And if you look at my pies, I've actually got little pies set up here. I actually downloaded this. you can share like your pies. So somebody shared these pies, and so this like they shared this pie, and this pie has all these pies inside it. I know it sounds a little confusing, but basically they've separated by sectors, consumer staples, industry, all that good stuff. And in each one of these has those companies. All of these companies are currently dividend aristocrats, which means that they have paid dividends for over 25 years and grown those dividends every year. So they're all solid companies. um, so yeah, that's M1, and that's my plan. So right now my plan is to get my money out of Betterment, which I already set up my withdrawals, and then to get my money out of Robinhood. Even though I love Robinhood, I fully support Robinhood. When they have an IPO, I'm probably going to purchase their stock, um, which I know they're planning on doing very soon. And but for dividend investing, I find M1s is going to be a much better tool to use. And I've already told you all the reasons. So anyway, yeah, that's it. Video's getting long. I'll talk to you guys later, and I'll once I get this going and whatnot, then I'll give you updates and tell you what companies I've added, subtracted, kept, why I did it. Uh, the progress I'm making, the returns I'm getting, the dividends I'm getting, all that good stuff. So stay tuned. Thanks, guys.